Welcome to the world of high stakes, nerves of steel, and the potential for immense wealth. Yes, we're talking about the stock market. A realm of opportunity where fortunes are made, financial futures are transformed, and dreams are either realized or shattered. But what's the secret to navigating this unpredictable sea of numbers and trends? Well, successful investing isn't just about luck. It's about strategies, insights, and understanding the market's ebb and flow. It's about recognizing opportunities when they arise and having the courage to seize them. It's about learning from the past, predicting the future, and making informed decisions based on hard data and careful analysis. And who better to learn from than the masters of the game? The titans of industry who've not only survived but thrived in this challenging arena. The famous investors who've made their names and fortunes in the stock market. The best way to learn about these strategies? By studying the masters of the game, the famous investors who've made their names and fortunes in the stock market. When talking about famous investors, it's impossible not to start with Warren Buffett. This titan of the investing world is known for his simple yet effective investment strategy. Warren Buffett, the Oracle of Omaha, is a name synonymous with success in the investment realm. His strategy? Value investing. But what does this mean exactly? Value investing is all about identifying stocks that are undervalued by the market. It's about finding companies that are like diamonds in the rough. Those precious gems that everyone else has overlooked. Buffett's approach is steeped in the teachings of his mentor, Benjamin Graham, the father of value investing. Graham's philosophy was simple. Look for stocks that are trading for less than their intrinsic value. This means identifying companies that are fundamentally strong, but for some reason, are not being valued correctly by the market. But value investing is not just about finding undervalued stocks, it's also about patience. Buffett is known for his long-term investment approach. He's not interested in the daily ups and downs of the stock market. Instead, he focuses on the long-term potential of a company. He once said, "Our favorite holding period is forever." This shows his commitment to holding on to stocks for as long as they continue to deliver value. Buffett's investment style also reflects his famous quote, "Be fearful when others are greedy, and be greedy when others are fearful." This quote encapsulates his contrarian approach to investing. When others are selling out of fear, Buffett sees this as an opportunity to buy. Conversely, when others are buying out of greed, Buffett takes this as a sign to be cautious. Warren Buffett's investment strategy is not flashy or complex, it's based on solid principles of value investing, patience, and contrarian thinking. It's a strategy that has made him one of the richest men in the world, and it's a strategy that continues to influence investors worldwide. Buffett's success proves that patience and value investing can indeed be a recipe for incredible wealth. His story serves as a reminder that in the investing world, sometimes the tortoise does beat the hare. Next on our list we have the man who broke the Bank of England, George Soros. Soros, a Hungarian-born investor, is renowned for his audacious and high-stakes investment strategies that have often paid off in a big way. Soros's investment philosophy is rooted in his theory of reflexivity. In essence, this theory suggests that the valuation of any market or asset isn't solely determined by its inherent or fundamental value. Instead, Soros posits that the perceptions and actions of the participants involved can significantly influence and sometimes even distort these valuations. This view often leads Soros to make investments that seem counterintuitive to others. But when the market's perceptions shift as he anticipates, the rewards can be substantial. Take for instance his famed bet against the British pound in the early 90s. Soros, perceiving a fundamental weakness in the currency that others overlooked, made a bold move. He took a massive short position against the pound, betting that its value would decrease. When the Bank of England was forced to devalue the pound, Soros's bet paid off, earning him a profit of around $1 billion. This audacious move earned him the moniker, the man who broke the Bank of England. But Soros's style is not for the faint of heart. His high-stakes, high-reward approach requires a deep understanding of market dynamics, an ability to perceive shifts in market sentiment, and, importantly, a willingness to take on substantial risk. It's a style that has made him one of the most successful investors of his time, but it's also one that can lead to significant losses if the market doesn't shift as anticipated. In the end, Soros's story is a testament to the power of bold, high-stakes investing. It's a reminder that understanding the market isn't just about crunching numbers and analyzing fundamentals, it's also about understanding the psychology of the market participants and being willing to make bold moves when you perceive a mispricing. Soros's story shows that sometimes, high risk can indeed lead to high reward. Now let's talk about Peter Lynch, the man who made Fidelity's Magellan Fund one of the best performing funds in the world. Peter Lynch is a legend in the investment world, and for a good reason. He managed to generate an annual average return of 29% during his 13-year tenure at the helm of the Magellan Fund, making it the top-performing general equity fund in the world during that period. And how did he achieve this? By using a strategy that was simple, yet incredibly effective. Lynch's investment philosophy can be summarized in a phrase that he made famous: invest in what you know. He believed in the power of observation and common sense. According to Lynch, the average investor has the ability to observe trends and products in their daily lives, which can lead to successful investment ideas. For example, if you love a particular brand of coffee and notice that the lines at the local coffee shop are always long, this could be a clue that the company is doing well and might be a good investment. Lynch urged investors to do their homework and understand the businesses they invest in, rather than just following trends or tips. But Lynch's approach wasn't just about understanding the product or service a company offered. He also placed a great deal of emphasis on the quality of a company's management and its financials. He believed that good management is crucial to a company's success, and he scrutinized balance sheets and income statements to ensure a company was financially healthy before investing. Lynch was also a proponent of diversification, holding hundreds of stocks in his portfolio at any given time. He believed that this not only spread out risk, but also increased the chances of hitting on a big winner. Lynch's success shows that sometimes the best investment opportunities are those right in front of us. So, the next time you're standing in line for your favorite cup of coffee, think about Peter Lynch, and consider whether you're looking at a potential investment. These investors, each with their unique strategies, have mastered the art of investing. Let's take a moment to revisit their wisdom and insights. Warren Buffett, the Oracle of Omaha, is one of the most successful investors of all time. He advocates for value investing, buying stocks that are undervalued and holding them for the long term. Buffett's approach is all about patience and discipline, waiting for the right opportunity and not getting swept away by market trends or hysteria. Then we have George Soros, the man who broke the Bank of England. His strategy is more aggressive and speculative. He is known for his theory of reflexivity, which argues that the perceptions of market participants can shape market realities. Soros is not afraid to take risks where he sees potential, and his boldness has led to significant returns. Peter Lynch, the legendary manager of the Magellan Fund at Fidelity, has a more straightforward approach. He believes in investing in what you know, buying stocks in industries and companies that you understand. Lynch also emphasizes the importance of research and due diligence before making any investment decisions. These three investors may have different strategies, but they all understand the importance of having a strategy to begin with. They know that investing isn't just about picking stocks, but about understanding the market, assessing risks, and being patient. Investing is as much a mental game as it is a financial one. They also remind us that there is no one-size-fits-all approach to investing. What works for one person might not work for another. It's about finding the strategy that fits your financial goals, risk tolerance, and understanding of the market. And sometimes, as these masters have shown us, it's about trusting your gut. As we have learned from these masters, successful investing isn't just about picking stocks. It's about having a strategy, understanding the market, and sometimes just trusting your gut. Each of these investors has their unique approach, but they all share a common understanding that investing is about more than just making money. It's about building wealth for the long term. Investing can be a powerful tool for building wealth. Think about the greats we've introduced today: Warren Buffett, George Soros, Peter Lynch. Their stories aren't just tales of success, they're lessons in financial literacy. Lessons that you can learn and apply. Imagine waking up one day, knowing your money is working for you, not the other way around. Imagine having the freedom to live life on your terms, all because you decided to learn about investing. We're here to help you on that journey. We're here to provide you with the knowledge, the insights, the strategies used by some of the most successful investors in history. And all you have to do is hit that subscribe button. By subscribing to our channel, you're taking that first step towards financial independence. You're choosing to educate yourself. You're choosing to invest in your future. So, subscribe to our channel, and together, let's build a financially secure future.